PayPal is currently one of the most followed stocks by retail investors, and it is also up 16% after its recent earnings report. However, the stock is still down 80% from its all-time highs, which is also interesting because the business continues to grow its revenues and its operating income. The market seems like it has completely given up on PayPal stock, but it also seems like the sentiment towards this business could be starting to shift due to its continued fundamental growth and performance. At the very least, it is an interesting stock to follow, and in today's video, I want to share my thoughts on PayPal's most recent earnings and if the stock is looking cheap today. Before we get into the video though, I just want to say that I work extremely hard to get these earnings videos out as soon as possible. So if you enjoy or appreciate these videos, then please remember to leave a like on it, as it does really help out my channel. And with that being said, let's now hop into PayPal's stock. Alright, so as always, I went through PayPal's most recent earnings report and I found some of the highlights that I want to share with all of you. So right here we can see that PayPal's revenue increased by 8% year over year. Its transaction margin dollars also increased by 8%. Its operating income increased by 17%. Its operating margin expanded by 1.26% to 16.8%. And its GAAP earnings per share increased by 17% year over year. So right away, this actually does look like a pretty strong earnings report for PayPal. Again, revenue is up 8%, operating income is up 17%, and earnings per share is also up 17%. Now, if we take a look at the total operating results, we can see that total payment volume also increased by 11% year over year. Payment transactions are up 8%. However, active accounts did decline by 0.4% year over year to 429 million accounts. Now, this is one of the bearish points in the overall earnings report, because as I have been saying for over the past year now, PayPal's active accounts is not really growing. And what that overall means is that for PayPal to continue growing its revenues and its overall profitability, it does have to continue generating more revenue per user, or basically extracting more revenues and cash flows from every user they have on their platform. And personally, I do believe that there is a limit to how much revenues PayPal can suck out of every one of its customers, which also means that I do believe that there is a ceiling that PayPal is going to hit eventually on how much revenue it can actually generate if it does not continue to add new products or figure out how to continue growing its overall customer base. So that is something that I am watching out for, and that is a point that I do think investors should be aware of. But moving on to cash flows, we can see that adjusted free cash flow for this quarter was $1.1 billion. Moving on to the balance sheet, we can see that cash and cash equivalents is sitting at $18.3 billion, and debt totaled $12.2 billion. So PayPal does have more cash than debt on the balance sheet. So in general, I do think that the balance sheet for PayPal is looking pretty strong right now. Now moving on to the next screenshot, this one is the account and activity metrics. So we already discussed that the active accounts is not really growing year over year. However, we can see that the number of payment transactions did grow by 8% year over year, and the transactions per active account did grow 11% year over year. And this is exactly what I was just talking about. So since PayPal's active accounts are not growing, how the business is continuing to grow its revenue is getting the people who have accounts with PayPal to use their PayPal accounts more and produce more transactions per active account. So again, they are basically just finding ways to get their existing customer base to use PayPal more and have more transactions, and that is how the company is overall growing right now. Now, this next screenshot shows us the long-term growth of PayPal's active accounts, and we can see that in the first quarter of 2022, they had that 429 million active accounts. So basically, active accounts have not grown for 2 years now. Back in the first quarter of 2021, they were sitting at 4.9 billion, and they have grown to 6.6 billion in the most recent quarter. Transactions per active account was also 44.2 in the third quarter of 2021, and now they are sitting at basically 61. So the transactions per active accounts has grown by about 50%, or just under 50% over the past 3 years. So PayPal has actually done a really good job on increasing the usage of every active account. And I do think that this is a good thing for PayPal's overall business, as this is how the business has been growing over the past 3 years now. However, again, I do think that the active accounts not growing is still a bearish point for the overall company. Moving on to the next screenshot, this one is the total payment volume mix across PayPal's payment platform. So this is basically the different business segments within PayPal. And we can see that branded checkout did grow by 6% year over year. PSP unbranded card processing did grow by 19% year over year. And this is the largest portion of PayPal's business, sitting at 30% of the total transaction payment volume. Unbranded card processing is also PayPal's Braintree business, which I will explain a little bit more in depth here in a minute. But next we can see that Venmo did grow by 8% year over year, P2P x Venmo did grow by 4%, other merchant services did grow by 15%, and eBay declined by 6% year over year. Total transaction payment volume did grow by 11% year over year once again. So this unbranded card processing is really where a lot of PayPal's growth is currently coming from. And again, this is the Braintree growth. So then the question is, what actually is Braintree? Well, Braintree allows online merchants to accept and process online payments. It's a very easy drag and drop solution that also reduces checkout friction, and therefore, it is said to increase overall payment conversions. Many businesses report seeing higher revenue and decreased chargebacks after implementing Braintree's solutions. This is all through Braintree making the checkout experience more streamlined and frictionless. This segment of PayPal's business has been the fastest growing for a while now as well. In fact, James Chris, who is the CEO of PayPal now, had this to say in the most recent quarter's conference call. PayPal is a top payment method for advertisers and consumers globally across Meta's family of apps. Meta's donations and charitable giving campaigns now run through the PayPal Giving Fund platform. Meta pays out creators and developers using Hyperwallet, and Meta uses Braintree for credit card processing. So Meta uses PayPal's payment solutions, and they also use Braintree for all of the credit card processing on the Meta platform. So as Meta continues to grow, PayPal should continue to grow as well, assuming that Meta does want to stick with PayPal and Braintree over the long term. The CEO also said, "We continue to execute with high velocity to enhance customer experiences and value for our large enterprises, SMBs, and consumers. We are building the foundation for our next phase of growth." So it sounds like PayPal is continuing to invest in their product and overall provide more value to their businesses and their business clients and customers. And the company sounds like it is preparing for its next phase of growth. Now, while we're on the transcript from the conference call, the CEO also had this to say, "I'm pleased to announce that in August, we are delivering on that commitment and making Fastlane generally available to merchants in the United States. We have heard from many merchants who are excited to add Fastlane and have a robust go-to-market strategy. As I've shared before, data from our early adopters shows that returning Fastlane users convert at nearly 80% versus the industry average guest checkout conversion closer to 50%. This gives us increasing confidence that Fastlane will accelerate PayPal's ability to capture the roughly 60% share of e-commerce purchases made without a branded market." So this is the CEO of PayPal talking about a brand new product called Fastlane that they are going to be rolling out in the United States over the coming quarters now. And he is saying that this Fastlane product does convert at a much higher rate than the industry average. So then the question is, what is Fastlane? And Fastlane is a fast and easy way to secure payments online. PayPal will save your credit card and shipping details and then pre-fill your data on future purchases wherever Fastlane is available. PayPal's Fastlane basically makes it so you do not have to type in your credit card and shipping information at every single checkout. So theoretically, if every online store had Fastlane enabled, then you would never have to type in your credit card and shipping information, which would make the checkout process and experience much more seamless and efficient. Now, as a founder of a software company, I can tell you that removing the number of clicks a user needs to do is extremely important, as every friction point means a drop-off in sales. So if there are less friction points for the customer, then you will see an increase in sales and in overall conversions. And again, the CEO of PayPal says that their Fastlane users see conversion rates of 80% versus the industry average of 50%. So the reduced friction is causing higher checkout conversions, which is obviously attractive for any online business. Now, for Fastlane to be successful, PayPal will want as many merchants as possible to use it, obviously, right? But this is because a product like this benefits from everyone using it, because then the consumer doesn't have to input any of their credit card information or shipping details anywhere online. For example, if only one company has Fastlane enabled, then it isn't that useful, and it's not really providing that much of a service to consumers, right? So this is one of those products where the more businesses that use it, the more value it adds to the customer. Therefore, if PayPal can successfully deploy this technology at scale across the majority of online stores, then it will create a network effect and ultimately add a moat for PayPal's business. But now let's quickly head back to PayPal's Q2 investor presentation and take a look at the guidance that they have for the next quarter and for the full year of 2024. So here we can see that for the next quarter, PayPal is expecting the revenue to grow mid-single digits, which is around 5 to 6% year-over-year revenue growth. They are also expecting earnings per share to be in the high single digit growth, so probably around 7 to 9% earnings per share growth for the next quarter. Now, for the full year, we can see that PayPal is expecting approximately $6 billion in free cash flow and share repurchases of $6 billion as well. So basically, PayPal wants to use all of the free cash flow generated in 2024 to buy back shares, which I actually don't think is a bad move because there is a strong argument that PayPal's stock is undervalued today. So now let's head back over to Stock Unlock really quickly and take a look at PayPal's long-term financials here. So here we can see that the revenue for PayPal as of the most recent quarter is hitting an all-time high once again, and the revenue growth for PayPal has also remained quite consistent. This is the exact same story for PayPal's operating income. It is hitting an all-time high and is now sitting at $5.44 billion as of the most recent quarter in the trailing 12 months. However, when we take a look at PayPal's operating cash flows, we can see that they have been a lot more volatile throughout history. And since PayPal's cash flows have been a lot more volatile, I am actually going to use the operating income when I am valuing PayPal's business here in a minute. And again, the reason for that is because the operating income has been much more consistent and less volatile. And therefore, when you are looking at price ratios for PayPal's business, you will get a better indicator of how the business has been valued historically when you use the operating income, because it has been the more consistent metric. Now, here we can see that PayPal's market cap is $69 billion on the stock market today. So if we go $69 billion in market cap and divide that by the $6 billion of free cash flow that PayPal is projecting to produce in the year of 2024, then we get a price to free cash flow of only 11.5 today. Now, why I think that this is looking arguably cheap is because if we go 100 divided by 11.5, then this means that PayPal has a free cash flow yield on cost of the shares today of about 8.7%. What this means is that if PayPal wanted to return 100% of its free cash flow to its shareholders in the form of a dividend or a share repurchase right now, then it could deliver an 8.7% yield or return to its shareholders, which is significantly above what government bonds are offering today, and in general is a pretty strong yield or return to shareholders. And in my opinion, this price today for PayPal's stock is not reflecting any future growth. Or in other words, if PayPal can actually continue to grow the business over the long term, then I do not think that the price of the business today is factoring in that future growth at all. So now let's head over to Stock Unlock's Freeform tool and take a look at PayPal's historical price to operating income. And right now, the company is trading for a price to operating income of about 11.25, which is basically the lowest the stock has ever traded for. And if we take a look at PayPal's historical average price to operating income over the past 12 years, we can see that it is 39.5. So PayPal's price to operating income today is roughly a third of the company's long-term historical averages. However, here in 2021, PayPal's price to operating income did get up to 97, and I do believe that PayPal's business was massively overvalued in the year of 2021. So this is kind of skewing PayPal's historical averages to the upside. However, if we take a look at PayPal's price to operating income in the stock market crash of 2020, we can see that it was about 40.7, and even back here in 2016, PayPal was routinely trading for a price to operating income of about 27 to 28. So PayPal's price to operating income today versus how the market has historically valued this business is ridiculously low. And even just taking a look at PayPal's business today, a price to operating income of 11 for a business that is continuing to grow its revenues at 8% and its operating income at double-digit growth rates, I do think is looking very cheap. And if PayPal can continue to grow its business at 8% annually going forward from here, then I do think that this is looking like a very cheap stock because, again, I don't think that the price today is factoring in any future growth. Now, the last thing that I want to do in this video is head over to Stock Unlock's discounted cash flow calculator and enter in some pretty bearish metrics for PayPal, in my opinion, to show you how the market is currently valuing the stock and really how undervalued the stock could be looking. So the metrics that I just put into this DCF calculator are 5% annual operating income growth over the next 5 years, 4% annual buybacks, which is actually lower than the 6% buybacks that PayPal did over the past year, and a 15 price to operating income, which is higher than PayPal is trading today, but is still significantly below the company's long-term historical average price to operating income ratios. And a 15 price to operating income, I actually do think would be fair for this business, if not still undervaluing this business. And when we enter in these metrics, which I do think are on the pessimistic end, we get a compounded annual growth rate to PayPal's stock price of 13% annually here, which is a higher return than the S&P 500's historical average of about 10% annually. So basically what I'm trying to say here is that even with these pessimistic metrics, it does look like PayPal could produce market-beating returns over the next 5 years. Now, if we bump the operating income growth rate up to 8% and the price to operating income ratio up to 20, which is more in line with the company's historical averages, then we get a compounded annual growth rate to the stock price of 23%, which is a very high return to the share price over the next 5 years. Now, these numbers here are on the more bullish end, but I do want to show you kind of how this DCF calculator works and how I think about investing as a whole. I like to take a look at what I think are pessimistic numbers and then also bullish numbers to see kind of what the stock could produce and the range that the stock could produce over the next 5 years as well. But ultimately, even with the pessimistic numbers, it does look like PayPal stock could be offering value today. And I do also believe that there is a strong argument that PayPal stock is looking cheap and undervalued today as well. So to wrap up this video, I created a very quick pros and cons list for PayPal's stock today. And let's start with the pros. And the first pro is that PayPal's new CEO does seem to be righting the ship and the business is continuing to grow. The stock-based compensation at PayPal is also coming down, which is great to see. We didn't go through the cash flow statement in this video, but if you go and take a look at the cash flow statement, PayPal's stock-based compensation has actually declined year over year, despite the overall business's fundamentals continuing to grow. And again, I do think that this is a good sign, and it shows that the business is trying to align itself more with the public shareholders of the company. PayPal is also continuing to build new products that could create network effects and moats. And in specific, this one is the Fast Lane product that PayPal is planning to roll out to the US in the coming quarters. The stock is also not pricing in any future growth right now, at least in my own opinion, and therefore all future fundamental growth should directly benefit shareholders today. Now, moving on to the cons, PayPal's accounts are not growing, and this means that PayPal has had to get existing customers to use the platform more to continue generating revenue growth and profitability growth. There is a limit to how much revenue PayPal can get per customer though, so I do think that PayPal is going to have to figure out how to continue growing its overall accounts over the long term. New products do show promise, but they need to be proven at scale as well. And this is the Fast Lane product as well. It shows promise with a small pilot group, but can PayPal actually roll this out and scale it effectively? That needs to be seen. The payments industry is also very competitive, and there are new players joining all the time. So PayPal basically needs to continue fending off new competitors and the overall competition within the payments industry. And I do think that PayPal has done a good job of that historically, but going forward, it is worth noting that this is a competitive industry and PayPal will have to continue fighting off competition over the long term. But with all that being said, those are my thoughts on PayPal's earnings and the price of the stock today. And if you enjoyed this video, then please remember to leave a like on it as it does really help out my channel. Also, if you're new here and you want to stay up to date with all of the earnings releases that are coming out, then please make sure to subscribe to my channel because that would also be pretty awesome. But lastly, thank you all so much for tuning in today. As always, I truly do appreciate it, and I really hope to see you all again in my next video.